Hi everyone, and welcome back to ACCA P4, the live session. Today the objective is to look at the investment appraisals that we left, which is the international investment appraisal question, and then we'll move quickly to the day's objective. And today's objective is session 6, which is the valuation, acquisitions, and measures. So we're quickly going to solve the question that we left last time, and international investment appraisals, and we move on to chapter number 9. So let's go straight, and we pick the question and international investment appraisals. So the question can be found on page 146, page 146 of your lecture notes, and I'll quickly read. But before then, let's refresh our minds on that international investment appraisals. We said international investment appraisals, you are actually resident in country A and you're doing the project in country B. So the cash flows are supposed to be generated in the country B currency. And when you get the net cash flows, you remit it to your home country by estimating the exchange rate, either using the purchasing power parity, interest rate parity, or whatever basis the examiner will give to you. When you bring the money into your country, you ask the question, is there additional tax that is supposed to be paid? And as such, is there any double taxation? Then you sort out any other cash flows associated with the project that will be incurred or earned in your country. And then you get the overall net cash flows. When you get that overall net cash flows, then you will ask, what investment appraisal technique am I using? Am I using payback? Am I using NPV? Am I using adjusted present value? Am I using internal rate of return? Which method? However, technically, so far as P4 is concerned, it is between NPV and then adjusted present values. So let's take this broad day question to illustrate. Let's take this broad day question to illustrate. So I read, Broad Day PLC is considering whether to establish a subsidiary in the USA. The subsidiary will cost a total of $20 million, including $4 million for working capital. A suitable existing factory and machinery have been located and production could commence quickly. A payment of $19 million will be required immediately, with the remainder required at the end of year 1. Production and sales are forecast at 50,000 units in the first year and 100,000 units per year thereafter. The unit price, unit variable cost, and total fixed cost in year 1 are expected to be 140 and 1 million respectively. After year 1, prices and costs are expected to rise at the same rate as the previous year's level of inflation in the USA. This is forecast to be 5% per year for the next 5 years. In addition, a fixed royalty of £5 per unit will be payable to the parent company, payment to be made at the end of each year. Brockday has a 4-year planning horizon and estimates that the realizable value of the fixed asset in 4 years' time will be $20 million. It is the company's policy to remit the maximum funds possible to the parent company at the end of each year. Assume that there are no legal complications to prevent this. Brockday currently exports to the USA, yielding an after-tax net cash flow of $100,000. No production will be exported to the USA if the subsidiary is established. It is expected that new export market of a similar worth in Southern Europe could replace export to the USA. United Kingdom production is at full capacity, and there are no plans for further expansion in capacity. Tax on the company's profit is at the rate of 50% in both countries, payable 1 year in arrears. A double taxation treaty exists between the UK and the USA, and no double tax is expected to arise. No withholding tax is levied on royalties payable from the USA to the UK. Tax allowable depreciation is at the rate of 25% on straight line basis on all fixed assets. Brogdale believes that the appropriate beta for this investment is 1.2. The after-tax market rate of return is 12%, and the risk-free rate of interest is 7% after tax. The current spot exchange rate is $1.3 per pound, and the pound is expected to fall in value by approximately 5% per year relative to the US dollar. Required: A. Evaluate the proposed investment from the viewpoint of Brogdale. State clearly any assumptions that you make. B. What further information and analysis might be useful in the evaluation of this project? The A didn't tell us specifically what investment appraisal technique we should use. So your thought should be, am I going to use NPV or am I going to use APV? Last week we said where there are issues called subsidized loans and all that, we need to think of using the APV. So where those characteristics are not in there, then we can use our normal NPV. So as long as nothing is said about issue cost, subsidized loans in the question, I can normally evaluate this project on financial grounds using the NPV. If I have to calculate the NPV, I need those three variables, and those three variables will be the number of years, the relevant cash flows, and the appropriate discount factor. Therefore, how many years is this project supposed to go? Question says Brogdale has a 4-year planning horizon, so the project will last for 4 years. So I go and pick 4 years. Okay. So I will say years. Year 0, 1, 2, 3, 4. I leave space in case something should go somewhere. Brogdale is purported to be living in the UK and they're going to do the project in US. So this becomes an international investment appraisal. As long as the project will be done in US, I would have to generate the cash flows first in the dollars. So I will say dollar in thousands. As long as the project will be done in the USA, you need to first generate the cash flows in terms of the dollar. So now, my first thing I will need to do is for my sales. What will be my sales? I leave space. I have to go and do workings on the sales and come. So workings 1 is going to be on sales. And as such, I will say year 1, year 2, year 3, year 4. I know sales is selling price multiplied by inflation. Question is telling me that what is the selling price adjusted by inflation and multiplied by unit. The question is telling me 50,000 units in the first year and 100,000 units thereafter. However, selling price is $100 and is subject to inflation of 5%. So to do the calculation, I will say selling price in terms of year 1 is 100, subject to inflation of 5%. So 1.05 times 100 will give you the 105 times 1.05, which is 110.25, and then next is 115.76. What will be the unit? Unit, they said first year is 50, then 100, 100, 100. So how much will be my sales figures? I need to multiply this by that, which is 5,000 here, 10512, and this is 11025, and this is 11576. So these are my sales figures. I will need to go and multiply, show it in the main calculations. So I go up here, and then I will say sales. Year 1 is 5,000. Year 2 is 10,500. Okay. And then the next one is 11025. And then 11576. I have to do the same thing for variable cost. You go down quickly to do the calculations for variable costs. So it follows the same principle as you did in your domestic investment appraisals. It's like you are generating the cash flows first in the US, domestic investment appraisals in US. What is the variable cost per unit? Question said year 1 is 40 and is subject to inflation of 5%. So I'll have 42 here times 1.05 again is 44.1 and then 46.31. What then are the units? Unit here is 50, 100, 100 and then 100. And what will be your figures? This is 2,000, 4,200, 44, 4410, and then this is 4631. So these are the variable costs. I move up to go and show the calculations and the variable costs. So first one is going to be 2,000. The second one was is 4,200. Third one 4410 and then 4631. Then I asked, there is a fixed cost, and because we are doing the project in a country for the first time, that fixed cost automatically becomes incremental fixed cost to us, which makes it relevant. And question says the fixed cost is 1 million in year 1, and that fixed cost too is subject to inflation of 5%. So this is 1050. Okay. 1103. And then 1158. The question is also telling us that there is an additional cost. It said here, in addition, a fixed royalty of £5 per unit will be payable to the parent company, payment to be made at the end of each year. Payment to be made at the end of each year. So I also have to go and do the calculations for the royalties. Okay, so I leave space, go and do the calculations for the royalties. So my workings 3, I will say royalties, and then year 1, year 2, year 3, year 4. Royalties, they said, is per unit of 5. So £5 per unit, and the unit that you have, they said, is 50, 100, 100 and 100. International investment appraisals need you to be moving quickly because it demands time. So you do not have to be hesitating. You have to be flowing. So I will say this is 250. This is 500, this is 500, this is 500. Because it is in pounds here, this is also in pounds. But you are generating the cash flows in dollars. So what should you do? You have to convert these pounds into the dollars. And as such, you need exchange rate. You need exchange rate. Exchange rate is not given to you for the whole 4-year life. So it is your responsibility to pause here and go and calculate the exchange rate and bring yourself back. So I leave space down here and I say workings 4. What is my exchange rate? What is the exchange rate? I go to the question, you ask the question, how do the exchange rate is expected to be calculated? Even though we said you can use the purchasing power parity when interest rate is inflation rate is given, or you use the interest rate parity when interest rate is given. Here, the question is telling us to do something different. You have to follow the instructions. If you come to the last paragraph, it's telling you that the current spot exchange rate is 1.3 is to the pound, and the pound is expected to fall in value by approximately 5% per year relative to the dollar. If the pound is supposed to fall in value by 5%, then it means the dollar is expected to appreciate. And when a currency appreciates, you need less of that currency for the same amount of the other currency. So if the dollar is going to appreciate by 5% because the pound is falling by that 5%, then every subsequent year we have to reduce the dollar rate by 0.95%, isn't it? Therefore, when a currency is appreciating, you would have to get less of that currency for the same amount. So if the dollar is appreciating by 5%, then it will move to 95% of the previous one. So this is how you calculate your exchange rate. Year 0, you're going to say the spot. They said it's $1.3 to the pound. So year 1, because the dollar is appreciating by 5%, it will move to 95%. 95% of 1.3. So 1.3 times 0.95 is 1.235. Then year 2 will be 95% of the 1.235 times 0.95, and that is 1.173. And then year 3, 95% of 1.173, which is 1.115, and then year 4, 95% of the 1.115, okay, that is 1.059, okay, 1.059, and then year 5, 95% of it multiplied by that. You press the equal sign, that is 1.006. So this will be the exchange rate over the period. And I need this exchange rate to convert the royalties from the pounds into the dollars. So year 1, we said is 1.235, 1.173, 1.115, and then 1.059. So having got this exchange rate, I can convert the pound royalties into dollars, because the U.S. subsidiary we are establishing will see the royalty as an expense. Therefore, what will be in dollars? So 250 times 1.235 is 309. 500 times 1.173 is 587. And then 500 times 1.115 is 558. And 500 times 1.059 is 530. So these are the figures for the royalties. These are the figures for the royalties. Okay, so let's move up. So you need to be organized and international investment appraisals. No, you cannot divide it by 1.05. No, you have to multiply by 95% because the dollar is appreciating. So if the dollar is 100 now and is appreciating by that 5%, in terms of currency, when something appreciates, it means you need less of it. So if it was 100% now, then it should go to 95%. It can't go to 105%. Okay, it should rather come down. When we say something is appreciating in currency terms, you rather reduce it, because when a currency appreciates, then it means you need less of it. You don't need more of it. It's opposite to our normal day-to-day definition of appreciation and depreciation. Normal day-to-day, if we say something has appreciated, you are adding to it. But something in currency terms, when we say it has appreciated, you will need less, okay, for the same amount of the other currency. So you rather deduct instead of adding. Okay, so that is the point in there. So let's go straight and we bring the royalty figures. So we're going to have the 309, and then the next one is 587, 558, and then 558 and 530. So these are the figures that we got there. These are the figures. Next, once I have got the cost, I have to sum up all of that. Okay, when you sum up all of that, what do you get? This is 5,000 minus 2,000 minus 1,000 minus 309, which is 1691. 10500 minus 42 minus 1015 minus 587, and that is 4663. 11025 minus 4410 minus 1103 minus 558 is 4954. 11576 minus 4631 minus 1158 minus 530, that is 5257. Okay, now be with me. In our domestic investment appraisals, we said when you get here, you do tax and tax savings on capital allowance. When it is international investment appraisals, I don't recommend that approach. Okay, don't copy what I'm going to do. I'm just using it to explain something. If my cash profit is, let's say, 1,000, this is my cash profit, and my capital allowance is, let's say, 1,200, and tax rate, for the sake of simplicity, is 30%. If you were doing your local or domestic investment appraisals, we said apply the tax on the cash profit. So I will say, oh, there's tax of 300, but because there's capital allowance of 1,002, it will save me 1,200 multiplied by the 30%, which is 360. And in as such, you will say you are deducting tax of 300 and you are saving what? Actually 360. So in effect, the tax is you are saving is 60. Okay, but as we all know from F6, we do not pay tax on cash profit. We do not get tax on the capital allowance as it is. Tax is a percentage based on the taxable profit. And taxable profit is your cash profit minus your capital allowance. So if I have to calculate a taxable profit here, I will say I have made a loss, a taxable loss of 200. That 200, when you multiply by the 30%, it will give you the 60. Okay, now be with me. If this is domestic investment appraisals, if you go by this, I am okay with it. If you go by that, I am also okay with it. But when you come to international investment appraisals, I am not okay with using tax and tax savings on capital allowance. Why? Because in domestic investment appraisals, the assumption here is that as I am doing this project, and this project is giving me a taxable loss of 200, I have got other projects that those projects are making a profit. And companies don't pay tax on individual projects. They pay tax on their overall taxable profit. So if I make a loss on this project and other projects make a profit, I will be able to set this 200 against the other project's profit. And as such, I will save tax of 60. If it is international investment appraisals, you have to be very careful here. Because if I am going to that country for the first time to do this new project, I haven't got any project there. So when I make this taxable loss of 200, the taxman in that country is not going to pay me 60 pounds or 60 of the currency for me making a loss. We don't pay you tax or money for you making a loss. Therefore, when it is international investment appraisals, if you go by tax and tax savings on capital allowance like this, and the examiner has built in a loss or a taxable loss, you might be tempted to do this 300, 360, and you say, oh, the taxman is giving you 60, which is not the case. Because when you make this loss in that country, as you haven't got any project which is also making profit to set this loss against, the best they can do for you is for you to carry forward this loss. You cannot get any tax benefits instantly. The best they can do for you is for you to carry forward. So my advice to students is, when you come to international investment appraisals only. If it is domestic investment appraisals, you can decide to do any way. But when you come to international investment appraisals only, I will advise you to calculate your taxable profit so that in case there's a taxable loss, you will see it and you carry forward, as we are going to see here. Okay, some people do less the capital allowance, calculate the tax, then you add back the capital allowance. That is also possible, but I don't normally recommend that, because some students, when they deduct the capital allowance, and then instead of them adding back, they forget. So I want you to get out, because we're dealing with cash flows. Go out, go and calculate your taxable profit, and then when you get your taxable profit, you bring them back. Okay, so I am going down there to calculate the taxable profit, which my taxable profit will be this cash profit here minus the capital allowance. So let's go down there. 169, okay, 1691, 4663, 4954, 5257. So these are the figures I will need here. I will explain another additional reasons why I will want you to calculate the tax on the taxable profit. So I'll come to workings 5 and I will say tax. I will say year 1, year 2, year 3, year 4. Okay, and I will say what are the cash profit. The cash profit we got there were 1691, 4663, 4954, and then 5257. These are the taxable or cash profit. 5257. I need to less my capital allowance in order to get the taxable profit. If I happen to get a loss, I carry forward the loss. So I will expect you to be doing the calculations like that. If you look at what we did in the note, we did the less capital allowance and we calculated the tax and we added it back. Most students, I don't know whether because of the pressure in the room, they forget to add it back. If you don't add it back, it is a very, very serious offense, because you have told the examiner that that capital allowance you have deducted involves movement of cash, and capital allowance does not involve movement of cash. Okay, so there are so many mathematical things they are doing, but generally tax is supposed to be applied on your taxable profit, which is your cash profit minus the capital allowance. So let's go to the question quickly and then we see what they're saying about capital allowance. It's telling me here, tax allowable depreciation, which we all know is the same as capital allowance. It's at the rate of 25% on straight line basis on all fixed asset. What is the fixed asset? If you come up here, it's telling us that the subsidiary will cost a total of 20 million, including 4 million for working capital. And we all know that capital employed is total asset minus current liabilities. And total asset is current asset plus the non-current asset. So if I deduct current liabilities from the current asset, it gives me working capital. So capital employed is the same as non-current asset plus working capital. So if the total capital we are employing is 20 million, of which 4 million is working capital, then the 16 million should be non-current asset. And we all know you cannot apply capital allowances on working capital. Nobody gives you capital allowances on working capital. We apply it on non-current asset. Therefore, out of this 20 million, 16 million relates to the non-current asset, and that is what is subject to the 25% every year. And it is a straight line. Once it's a straight line, the percentage is supposed to be based on the cost of it, and that cost is what we said is 16,000 or 16 million. So I'm going to say my capital allowance will be 16,000, 3 zeros up. So 25% of that, which is 4,000 every year, which is 4,000 every year. Okay, so if it is 4,000 every year, then the difference between these two should give me my taxable profit. You see, sometimes the examiner will hide the loss. If you have done tax on this and you've done tax savings on that, because the capital allowance is more than the cash profit, it would have given you a positive net effect. And you would have said the tax man is giving you money for you making a loss, and that doesn't happen. So that is the first reason why I want you to come here. Okay, so now let's go. So 4,000 minus 1,691 is given, is it 2,309? And then this is obviously 663. And then 954. And this is going to be 1,257. So these are the taxable profit or taxable loss. Yes, the 19 million and the 1 million are the cash flows, how it was paid. The capital allowance should be based on the cost. So the 20 million is your investment, capital you employed. But that capital you employed, it doesn't mean you are paying everything straightforward. When we get to the cash flows and we are bringing the initial investment, that is where we would have to consider how that cash flow went. Well, I told you there is investment phase and there is return phase. Investment phase doesn't mean the whole of the 20 million is supposed to be paid now. That is the capital we have to employ. Some might be paid year 0, some might be paid year 1. And when you are doing the cash flow, we are interested in the receipt and payment. So the cost of the asset, which is the 16,000, is what is subject to the capital allowance. It has got nothing to do with the cash flow when you paid it. Okay, so we will handle that bit soon. So now let's come to our tax again. The issue here is that as long as I have made a loss here, this loss, I don't have to apply a tax on it because I haven't got any other project that is making a profit where I can set this loss against. So the only thing I have to do is I have to carry this loss forward as many years I can go. What I can say here is that if the question doesn't say anything, carry on as you can go. But if the question tells you maybe in that country you cannot carry forward, then here you won't pay any tax, 0. And then the tax will be based on that. So when you go to the room, follow the instruction how far you can carry those laws. If the examiner don't say anything, then your assumption is that you will carry it forward until the whole loss is exhausted. So what will be the tax I'm supposed to pay? The project is in US, so if I've made this profit in US, I have to pay the US tax rate. Question told me the tax rate is 50%, so I have to pay 50%. So this 50%, year 1, I am paying nothing. I am also saving nothing because I haven't got any other profit to set this loss against. I'm going to carry this 2309 forward. Okay, so I have got 2309. Next year, I made a cash profit of 663. I'm setting it off against the 2309. So that from 663, that gives me a loss again. So here too, I'm not paying anything. It is left with 1646, and then year 3, I have made this profit. I'm setting off against the loss. So minus 954. That still is a loss. It means this year I still have to pay nothing. Then when I get to year 4, I made a profit of this. But there is a loss of 692 to be recouped. So when I take it from 1257, it is left with my 565. And this 565 is what I am supposed to pay tax on because I have carried forward the loss. And tax rate is 50%, so 50% of that should give me 283. And that is the tax. You quickly go up there. The moment you come here, you just tell yourself that I have sought out the tax and the tax savings on capital allowance. So simple, I say tax and I ask, when is tax paid? This is where the cash flow issue come in because here we are dealing with cash flows. Therefore, when will the tax be paid? Question said tax is paid 1 year in arrears. Therefore, the tax that I am supposed to pay in year 4 will be paid in year 5. I take it to year 5, and that is 283 minus tax and tax savings and capital allowance. Everything is sorted. Next, if I finish with my tax, I have to think about my capital items. What will be the capital invested? The initial investment we invested is the 20 million, but the question said we didn't pay the whole 20 million immediately. As he asked, we didn't pay the whole 20 million immediately. 19 million will be paid now, and 1 million will be paid in year 1. This is what they said. Okay, he said that a suitable existing factory, let's come here, a payment of 19 million will be required immediately, with the remainder required at the end of year 1. So this 20 million that we are investing, 19 million is supposed to be paid in year 0, which is 19,000, and 1 million should be paid in year 1. So this affects the cash flow. It doesn't affect the cost. The cost is what you incurred. It's not a matter of you have paid or you haven't paid. That is the cost of the asset. Okay, so when it comes to the cash flows, that is where you would have to think of when did you pay, okay, or when did you receive. Brilliant. Now, there is something that most people will forget here. When this question was originally said, most people forget about this. This 20 million, they said, is the non-current asset and working capital. And that 20 million is how we paid it in 19 million in year 0 and 1 million in year 1. And we all know, if the question don't say anything, the assumption here is that working capital is supposed to be recouped. So if working capital is supposed to be recouped, we have to recoup it at the end of the 4th year. And how will we recoup it? The working capital there out of the 20 million is 4 million. Therefore, the whole of the 4 million is supposed to be got at the end of year 4. Next thing I would have to remember is the residual value. And question gave us residual value. Question says the residual value at the end of the 4th year is going to be 20 million. So let's bring that 20 million. Let's bring that 20 million. And now be with me. Okay, 2 things people forgot when this question was originally asked was this. And then what I'm going to do. Okay, we all, when we do tax savings on capital allowance, we all said at the end of the project life, if the project is sold or the asset is sold, we might make a balancing charge when we sell it at a profit, or we might make a balancing allowance when we sell it at a loss. And if it is a balancing allowance, it should save us tax. If it is a balancing charge, we have to pay tax on it. Okay, now look at what we did and the tax and the capital allowance. Let's go there again. Okay, when we did the capital allowance, we had an asset with a 16,000, reduce our straight line method 25%, and we said every year is going to be 4,000. If every year is going to be 4,000 over the 4-year period, it means the total capital allowance we charge on the non-current asset is 16. Come the end of the life of the project, the tax written down value of this asset is going to be 0, because it was 16,000 and we capital allowance it for 16,000. So come the end of the asset life, in the books of the taxman, the value of the asset is 0. But come the end of the asset life, you said you are selling it at a residual value of 20 million. Therefore, you had an asset which is having a tax value of 0, and you sold it for 20 million, and as such, you made a balancing charge of 20 million. So if you made a balancing charge of a 20 million, which is a tax profit you have made, the taxman is supposed to charge you the 50%, and tax is paid 1 year in arrears. Therefore, we would have to push it back. Okay, so the 10,000 I am going to bring is not taxed on the residual value. is the tax on the balancing what charge. But because the residual value happens to be the same as the balancing charge, so this is tax on the balancing charge, which is the profit on the sale of the asset. Okay, and as such, it should go to the next, which is the 10,000. These are your cash flows. Working capital is sorted. So it's like you are doing domestic investment appraisals in the US. This is what we've done. If it's a domestic investment appraisal, we will get this net cash flow and we continue. So sum them up. I get 19,000 here. I will get 69146634954, and this is 100283 minus, and I'm going to get 5257 plus 24,000 is given 29257. So this is the net cash flows in the USA. But as we said, our shareholders are not in USA. Our shareholders are in the UK. So these monies are supposed to be remitted back to the UK. So if you have to remit it, technically, they call this remittable cash flows. Remittable. You are remitting the cash flows to the shareholders. So if I have to remit it into UK, I would have to convert these dollars into pounds. So I will need my exchange rate. And the exchange rate is what we calculated. Year 0, which is the spot rate, is 1.3, and we said is decreasing by 5%. So the second one is 1.235. Okay, 1.173, 1.145, that's what we calculated earlier, 1.059, 1.006. Then I will have to come and get my pounds. If you convert this, now your currency sign should change. Your currency sign should change into your home currency. And our home currency is the pound. So what will be the remitted? This one we call it the remitted cash flow, because now we have brought it into our country. In the exam room, you haven't got time to write all this. Just bring the figures. So 19,000 divided by 1.3 is given 14615. Okay, 691 divided by 1.25 is 560. 4663 divided by 1.173 is 3975. 4954 divided by 1.145 is 4327. 29257 divided by 1.059 is 27627. 10283 by 1.006 is 10222 minus. So these will be the cash flows brought into UK. If you bring it to UK taxman will say any money brought into my country is subject to tax. Okay, so you need to ask, is there any additional tax I would have to pay in UK? And as such, is there any double taxation agreement between the two countries? And let's listen to what the question said. Question said here, tax on the company's profit is at the rate of 50% in both countries, payable 1 year in arrears. There is double taxation agreement between the UK and the US. Okay, if there is double taxation agreement, you have to pay the highest percentage, as we saw last week. But here they said 50%, 50%. Therefore, there wouldn't be any additional tax to be paid in UK. But for the purpose of learning, I'm creating a scenario. Okay, assuming, I'm bringing you back here, the tax, assuming that UK percentage was 60%. If UK percentage was 60%, then there should be an additional tax of 10%. There should be an additional tax of 10% because we've paid 50% in the US. So when we come to UK, we have to pay additional 10%. Now be with me. The additional 10% should not be based on the remitted cash flows. All what you need to remember is we do not pay tax on cash flows. We pay tax on taxable profit. So US, we paid 50% on these taxable profit. Okay, so the extra 10% should also be based on this that taxable profit. And this is the second reason why, if it is international investment appraisals, I don't want you to go and do tax and tax savings on capital allowance. If this extra 10% occurs, if you have done tax and tax savings on capital allowances, you also have to do the 10% on tax and tax savings on capital allowance, which will be picking your time up. So if I get a taxable profit, I apply the host country's tax rate, which is 30%. Then if there is extra to be paid in my own country, like I've created this 60%, creating the 10% extra, okay, what I'm doing is not part of the question, just for knowledge, then I will say there should be an additional tax. And that additional tax in the UK should be the 10%. The 10% should be based on the taxable profit. And the taxable profit, we said we are carrying the loss forward. So here would have been 0, 0, 0. When you come to the fourth year, we said when you carry forward the loss, it is giving you a net cash profit, a net profit of 565 after you've actually carried forward the loss. And that is what we apply the 50% on together. We should have applied 60%. So UK taxman will say, you should have paid me 60%, but because you've paid this 50%, you have to pay me extra of that 10%. So 10% of this will give me 57. But remember, because this is in dollars, this is also in dollars. So what should we do? We need it in pounds. So you would have to bring the exchange rate. And then when you bring those exchange rates for the respective years, it should give you the tax figures. And then that is what you take into your calculation. So in case they go beyond, this is what you will do. Okay, but this question is telling us 50-50. And once it's 50-50, we don't need to pay any extra. So that is the end of it. Okay, so you move on. International investment appraisal will push you, so you need to be quick. So I will say there is no additional tax to be paid in UK because there is double taxation agreement. All of that has been paid. The residual value the tax on it has already been paid because we paid 50% on this 20 million, which gave us that. Therefore, you don't pay any tax on it. Okay, we don't pay any tax on it. So in case, if you have to do that, in case, based on this example I created, there's extra 10%, then that extra 10% too is supposed to be based on this 20 million, which is the balancing allowance or balancing charge in that case. And then you convert it using the exchange rate. Okay. So anything that you apply the 50% on, you would have to apply the extra 10% on. And because it will be in that other currency, you would have to exchange it using the exchange rate and bring it into your currency. So that 20 million will actually be taxed at that extra 10%. But obviously, given this question, because it's 50%, we don't need that. Brilliant. Okay, so let's go on. Now, what else? The moment I get this remitted cash flows, I ask the question, is there any double taxation agreement? And as such, is there any extra tax? And I sort that one out. My next level is there any other cash flows associated with this project that will happen in the UK? Don't forget, because they were going to produce our product, we charge them a royalty. And that royalties, they will see it as an expense. We have to see it as what? Income. And the royalties, when we did the calculation, we were charging them £5 per unit. And we said the royalties in pounds is this. Whom are they paying to? They are paying to the head office. Therefore, in the subsidiary, it's an expense. At the head office, it is what? Income. Therefore, we would have to go and bring that income. We would have to bring that income. Okay, so I will say royalties. The royalties were 250, 500, 500, and 500. That royalties, the question is it subject to UK tax? The answer is yes, because the royalty, we didn't pay tax on the royalties in the US. It rather saved us tax because it was an expense. So when you bring the royalty to UK taxman, even though there's double taxation agreement between UK and US, the UK taxman is going to tell you, but you haven't paid any tax on that 250, 500. Therefore, I haven't got any relief to be given to you. So you would have to pay tax on it. So what will be the tax on the royalties? The tax on the royalties. This is the UK rate. And here the UK rate is 50%. So assuming the UK rate was 60%, you would have applied on that. And UK tax is also paid 1 year in arrears. So this is 125, this is 215. $250 minus. And what will you do next? The next thing is there any other cash flows by way of loss contribution and all that? If you go to the question, the examiner stated something here which changes things. Brockday currently export to the USA yielding an after-tax net cash flow of 100,000. No production will be exported to the USA if the subsidiary is established. It is expected that the net export market of a similar worth in the southern Europe could replace export to the USA. Okay, currently we are producing goods in the UK, selling it in the US. That is giving us 100,000. If we establish the subsidiary in US, we're not going to get that 100,000 because we can't export to that place. We will lose that 100,000, which sounds like an opportunity cost, which would have been relevant. However, the question further stated that new export market of a similar worth in southern Europe could replace export to the US. So if we do the project in US, we are going to lose that 100,000, but that 100,000 will now be got from the Eastern Europe. Therefore, there is no opportunity cost. If this bit wasn't there, then we would have said, oh, we would have lost this 100, and that 100 will be an opportunity cost. But because we have got the alternative to bring that particular or get that particular money, whether I do the project in US or I don't do it, that 100,000 will continue to be made, and therefore it is not an opportunity cost. Leave it out. And that is all about your international investment appraisals. Okay, the only thing I would have to tell you here is that you have to move because it demands what? Time. So this is 8103975 plus 500 minus 125. This is 43504327 plus 500 minus 250 is 4487. 27627 plus 500 minus 250. This is 27877. 10222 plus 250, and this is 10472. So this is the overall net cash flows. This is the overall net cash flows. When you get this overall net cash flow, you ask, are you supposed to calculate MPV? If it's MPV, discounted with the project specific cost of capital. If it is APV, discounted using cost of equity and gear, and go and do the finance effect. If it is internal rate of return, I choose my own two red, sort them out. If it is modified internal rate of return, I reinvest these cash flows at the cost of capital. So you pick it from there. Because we are using MPV, I need the project specific cost of capital. I go to the question, how do you want me to calculate it? If the examiner wants to be funny here, then he will push you. You have to go and do proxy, angear, re-gear, capping, and WACC, if you remember. But here, we simplify the question here because we know we have already taught you this. So they say Brockday believes that the appropriate beta for this investment is 1.2. And I told you we don't use capping to calculate only cost of equity. We use CAPM to calculate cost of capital dependent on the beta. So if the overall beta of the project is 1.2, when I put it in the CAPM, it should give me the cost of the project. And this is giving me risk-free of 7% and market return of 12%. So what will be the discount factor? Will be the risk-free of 7 plus the beta of 1.2, market return, they say 12%, risk-free of that. And how much is he expected to give you? So 5 times 1.2 plus 7, which is 13%, which everybody should be able to discount this and get the MPV. So this is basically your international investment appraisals. This is basically your international investment appraisals. Okay, so generate the cash flows first in the country in which the project is supposed to be undertaken in their currency. When you get it, remit it by estimating the exchange rate. When you bring it into your country, ask, is there any additional tax I'm supposed to pay? And as such, is there any double taxation agreement between the two countries? When you finish, is there any other cash flows associated with the project that will be earned in my particular country? When you sort all of them out, you come and get the net cash flows. When you get the net cash flows, which method are you using? APV, discounted using cost of equity and gain. MPV, discounted using the project specific word, cost of capital. And then you follow your normal procedure. Every question and international investment appraisal, the examiner will want you to discuss about other factors. And as we saw, other factors might include political risk, exchange rate risk. It can have physical risk in terms of tax and all that. You discuss all of them. But whilst you are discussing, you can bring issues of sensitivity analysis. If the MPV that we did here is positive, we will say, oh yes, because the project is having a positive MPV, we should go ahead. Are we 100% sure of the accuracy of the figures that we use? It might not necessarily be so, because we're going to sit down, we say, oh, the project will be 5 years, and as such, these are the selling prices, variable cost, fixed cost units. For example, here we said variable cost, fixed cost, selling price, all of them are increasing by 5% inflation. How is it possible? Okay, selling price is 100, variable cost is 40. How easy can we come out with that? So the question is, we have to incorporate risk by asking ourselves how much these variables should change for the MPV to be equal to what? 0. Yes, there are so many questions in your revision kit relating to international investment appraisals. If you go there, you can see biting, you can see as a part C's. There are so many of them. Okay, there are so many international investment appraisal questions in there. Okay, I think even the December 2013. December 2013, question number 1 was international investment appraisals. Okay, for international investment appraisal, there are so many. The only problem here is the speed. Principle-wise, it's not too difficult. Principle-wise, it's not too difficult, but the speed, because it's like we're doing 2 domestic investment appraisals. Okay, so look at those other factors. Look at all those other factors. What I tell students here is, you don't go to the room that you're going to get everything perfect. And international investment appraisals, time might not allow you to do that. Time might not allow you to do that. Okay, so if you go to your note, there is another question at the back of this question, which is, I think, page 150, polycalc. You can try your hand on. You can try, but that polycalc is APV, International Investment Appraiser, APV, and any question you will let me know. Okay, so practice them. It's the normal investment appraisals. The only difference is how you generate the cash flows, generating the cash flows there, and then coming to generate the cash flows in your country. The moment you get to your net cash flow, it's normal techniques that you can use. Okay, so have a look at that. And the good news is that every time questions had come in international investment appraisals, P4 pass rate is good because students normally do well. Okay, now let's go to chapter number 9, which is valuations, acquisitions, and measures. You can't go to P4 without measures and acquisitions. No way. You can't go there because one of the questions definitely will relate to mergers and acquisitions. And what will be the areas you would have to learn and mergers and acquisitions? Mergers and acquisition questions relates to what I'm going to explain. So make sure before you go to the room, you know all of them across board. The first challenge in mergers and acquisition is, if A want to buy B, how much should it pay? What will be the purchase consideration? What will be the purchase consideration? And that purchase consideration will call for we to value the company, which is the valuation of business. So the common question here is the valuation of business. How much we should buy the other company. There will be the need for us to value it. If we value it and we see, we have to pay £100 to take over that company. The next question here is, if we have to pay 100, how should we pay it? And that is what is called mode of payment. Mode of payment. And we can use either cash, as you saw it in your F7 and then P2. You can use cash, you can use shares, or you can even use debt like loan note, okay, or deferred consideration. We all know that bit. And then what are the takeover regulations? Takeover regulations. Okay, and sometimes if A want to buy B, B might not necessarily be prepared to sell it to A. So B might decide to defend itself against that possible takeover. So what are the defensive strategies? Okay, what are the defensive strategies? So these are the areas the examiner will be worrying you. These are the areas the examiner will be worrying you. The most common one has been these two. The most common ones has been these two. And then probably he might also ask you why one company will want to buy another company. And that is basically what is called the synergies. What is called the synergies. What are the benefits associated with the acquisition? So all these are reading. All these are reading. Okay, the most one is the valuation. So let's quickly go to our note. So if you look at the way the note is prepared, the mode of payment, takeover, regulations, defensive tactics, and the synergies are the chapter number 10, and the business valuation is the chapter number 9. So let's quickly go through them. Why do we have to value a company if the company has got a market price? Why do we have to value a company if the company has got a market price? F9 told us that through efficient market hypothesis, there is no stock exchange in the world which is having a strong form. The best market in the world is semi-strong. And in semi-strong market, that market doesn't know insider information. And as a result of that, share prices could be overvalued or undervalued. So in that case, if the share price of company B I am going to buy is 6, should I pay 6? By paying 6, it could be that this is overvalued or undervalued because there might be something hiding in that company the market doesn't know. So based on the information available to the public, it has determined the demand and supply to price it at 6. Maybe there's something bad in that company we don't know. So if that something comes out, the price would have been somewhere 4. In that case, we would have said this market price is overvalued. How will we know? Nobody will be able to know that. So if you are going to buy that company, you would have to sit down and try to come out with a theoretical value, or they will call it the intrinsic value. So we are going to calculate the intrinsic value, and when we value theoretically and the market price is something like 8, then we will say, that company is undervalued, so we can afford to pay what? 6. If they don't want to sell to us at 6, Because their theoretical value is 8, we can induce them by giving them a premium. And the maximum premium we can pay is equal to 2, because we can't pay more than what? 8. Okay, so this is what we are going to do. So we can use the valuation in order to determine the terms and conditions for takeovers and mergers. We can also use the valuation to calculate the value of the share when the company is going to the stock exchange for the first time. We can do it for the purpose of advising, sell more of the shares or buy more of the shares. Your portfolio manager will tell you, okay, current share price of your company is 6. When I did my valuation, if their theoretical value is supposed to be 8, it means their share price is undervalued. Buy more of that shares, because reasonably it might go to 8, and then later you can sell it and you make a profit of 2. So we can do all of that. But so far as our P4 is concerned, we are not interested in any of them. We are interested in the valuation for the purpose of the takeovers. Okay, so let's go to the methods of valuing a company shares. Okay, we can use the dividend valuation model. We can use the discounted cash flow model. The discounted cash flow model is the same as the free cash flows, free cash flow method. And this is what has actually led us being behind time, because this is what took all the time. And the chapter number 2, if you can remember, we put it there because we know it's challenging, because this is where we should have done it. But because we know it's a bit challenging, we did it earlier so that you can practice and practice and practice. And almost all the P4 questions, the valuation is centered on free cash flow methodology. We can also use the PE ratio, net asset, and dividend yield. To be honest with you, nobody cares a P4 dividend yield method, the net asset basis. Even dividend valuation is not very popular. The popular one is the discounted cash flows and the PE ratio method. And PE ratio is straightforward. Okay, so now let's take them one. We quickly go through them. According to the dividend valuation model, the value of the company is the present value of the future dividend, discounted using the cost of equity. And dividend can be constant, dividend can be growing, or dividend can be anything. I need the present value of the future dividend using my cost of equity as the discount factor. So whatever we did and the free cash flow, that same principle is what we need for the dividend valuation. The only difference here is that the dividend valuation uses dividend as the cash flows, and then the free cash flow uses what? The free cash flows as the cash flows. Okay, and the free cash flow might use WACC, and dividend valuation will use the cost of equity. So the principle is the same, formulas are the same. Am I going to perpetuity? If it's going to perpetuity, is it constant or is it growing? Whatever the cash flows will be given to you, you are just finding the present value. So let's go straight here. The market expects a rate of return of 20% per annum on ordinary shares in Winterburn PLC, a company which is expected to pay constant annual dividend of 20p per share. At what price will the market value the shares? Because dividend is constant at 20p and the cost of equity is that, I have got a constant perpetuity. Constant perpetuity says the constant cash flow divided by cost of capital, and that is this. Don't even dream about this, okay? Then Seaman PLC. Seaman PLC is expected to pay a dividend of 30p per share next year. The market expects dividend to grow at a rate of 5% per annum and has a required return of 20%. What will be the market price? We said D0, 1 plus growth rate divided by cost of equity minus G, multiplied by discount factor of the base year. Same as we did in the free cash flows. Okay, but D0, 1 plus G is the next dividend, because this is the dividend now. 1 plus G will give you the next dividend, because this is like raise the power 1. Okay, therefore, when the question tell you next dividend, your next year free cash flow, it means they've done this bit already. If you remember when we're doing the free cash flow, we said the PV will be the free cash flow 1 plus the growth rate divided by, in that case, WACC minus the growth rate discount factor of what? The base year. Same thing. The issue is what discount factor are you using and what cash flow are you using? Am I using free cash flow? Am I using dividend? The same principles. They are all following present value analysis. So when I say next year's dividend is 30p, it means I have already grown it for you. So you will say D1, which is the 30, cost of capital is this, and then the growth rate, and that is the market price. Example 3, Merson PLC is just about to pay a dividend of 40p per share. Future dividends are expected to grow at a rate of 6% per annum. The market required return on shares of this risk level is 25%. What is the cum div share value? Okay, according to the dividend valuation, the value is the present value of the future cash flows. And we said that P0 is equal to the X div. So when they want me to get cum div, we said cum div is equal to the X plus the dividend. Therefore, when I use this formula to get the P0, which is the X div, I will add the dividend to it in order to get what? The cum div. Just as we did. If they give you cum div and you want the X div, knock off the dividend from the cum div to get the X div. If you get X div and you want the cum div, add the dividend to it. So basically, we're going to say here that dividend, is it growing or is it constant? Dividend is growing. So we'll say 40p into bracket 1.06 divided by 0.25 minus a 0.06. And how much are we going to get? 0.4 times 1.06 divided by 0.25 minus 0.06, and that is given 2.23. This is the P0, therefore is the X div. If I want the cum div, I would have to simply do 2.23 plus the dividend of 0.4, which will give 2.63. And that will be the cum div market price. What do I tell students? You need to stay in chapter 3 to learn the free cash flow well. When you come to these ones, they're going to be very easy for you. Now, Winterburn Wright PLC. Wright PLC has just paid a dividend of 15p per share. The market is in general agreement with directors' forecast of 30% growth in earnings and dividend for the next 2 years. Thereafter, a reasonable estimate is 15% growth in year 3, followed by 6% growth to perpetuity. Okay, the market required return on investment of this risk level is 25% per annum. Estimate the share value. The share value, according to dividend valuation, is the present value of the future cash flows. Today, they say is 15. For the next 2 years, they said it's going to grow by 30%. The third year, it will grow by 15%. And from the fourth year up to infinity, it's going to grow by 6%. He's combining present value and perpetuity. So, year 1, is it 0 point that? Okay, is it 15p multiplied by, because it's increasing by 3% or 30%, is it 1.3? This is year 1 dividend. Then that year 1 dividend, you grow it again by 30%. You've got year 2 dividend. Then year 2 dividend. Year 3 is growing by 15%. Get that. Cost of capital or equity is 25%. 25% is not on your formula sheet, but we know discount factor is 1 plus r raised the power n. So I pick my calculator. 1 divided by 1.25 equals, you get a 0.8. You divide by 1.25 again equals, you get a 0.64. Every other year you can press the equal sign and it will be given it to you. Okay, so that is what we did here to get that. For up to year 3, you multiply this and that, and it gives you the cash flows up to year 3. But the cash flows are subject to perpetuity of 6%. Have we got a perpetuity with growth? Have we got a perpetuity with growth? If we've got a perpetuity with growth, we all said that perpetuity with growth, the PV should be the D0, 1 plus the growth rate divided by cost of equity minus growth rate multiplied by discount factor of the base year. So what is the D0? If it is year 4 to infinity, year 3 becomes my base, and year 3 cash flow is the 29.15. So I will say 29.15 growing at 1.06. The cost of equity was given as 25% minus 0.06. And because year 3 is my base, I would have to go and pick year 3 discount factor. Just as we did some time back. Year 3 discount factor is 0.512, and I'll multiply this by 0.512. Okay, so I will have the 29.15 times 1.06 divided by 0.25 minus 0.06, all multiplied by 0.512, and that is giving you 83.26. And that 83.26 is what you would have to add to this in order to get the whole of the present value of the cash flows. All this we were trying to explain to you. All this we're trying to explain. If you get here, you can do year 4 to where? Infinity. And you will say 29.15, 1.06 divided by 0.25 minus 0.06 multiplied by 512. And you get the 83 here. All this we're trying to explain to you. Okay. So that is that. So go to chapter number 2. Go and learn that question that we did in the free cash flow to revise your annuity, perpetuity with growth, constant, present values, all that. Okay, now let's go to the free cash flow. We said the free cash flow says that the corporate value is the present value of, if I can refresh your mind on, we said according to the free cash flow, corporate value is the PV of the future free cash flow, discounting using the WACC. And then that corporate value is the value of equity plus value of debt. So if I want value of equity, is that corporate value minus value of debt. We saw all that. So technically, in the exam room, examiner is going to push you to calculate the free cash flow. Examiner is going to push you to calculate the WACC. You discount the two. Because now we know how to calculate WACC, we know how to calculate free cash flow. Discount the two, come and get the corporate value. Take the value of the debt out of it in order to get the value of what? Equity. If the examiner don't give you the value of debt, last week we learned, or this week we're going to learn how to value what? Debt. You value the debt. So this is how you would have to picture it. You need to get the framework. Anything the examiner doesn't give to you, it's your job to calculate it and bring it up. So if I need the value of equity and they've given me information on free cash flow, I calculate the free cash flow. If they've given me information on WACC, I use that information to calculate WACC. I discount the two. I've got my corporate value. To get the value of equity, I need the value of debt. Where is the value of debt? If the value of debt is given to me, I pick it. If the value of debt is not given to me, maybe the examiner is hiding. He's expecting me to calculate it. I'll ask the question, okay, if you haven't given it to me, how do you want me to calculate it? I calculate it, knock it from the corporate value, then your equity value is out. That sort of mechanism is what most of you are lacking. Examiner is not going to tell you, do this, then do that. He will be standing here and straightforward, he will tell you, do that. It is your job to do the sub before you lead yourself to that particular level. So let's go to the note. We pick this one. Nobody is going to give you this. No way. Because here, we were just refreshing your mind. We've done it better somewhere for you. Okay, so I normally tell students, don't bother yourself learning this bit. The time you used to do this, go there to chapter number 2 to see how we did the free cash flows. The predicted free cash flows of Miller Limited and all equity company for its planning horizon, which for simplicity is taken to be the next 5 years, are done. These are the free cash flows. The cost of capital is this. What will be the market value? Nobody will do this for you. So you get the cash flows, you discount it at the cost of capital, you've got the corporate value, full stop. Nobody should even dream about this. Okay, don't even dream about this because of what you've seen in chapter number 2. We just refreshing your mind in here. Okay, let's take this one too. The following data relating to Morrison Limited is expected to continue annually for the foreseeable future. Turnover, cost of goods sold, distribution costs, capital allowances, non-current asset, irredeemable bonds, working capital changes are assumed to be insignificant because of the absence of growth. Corporation tax rate, weighted average cost of capital, predicted inflation. Calculate the estimated equity market capitalization of this company. Okay, calculate the equity capitalization of this company. If I have to use the free cash flows, I know my free cash flow is operating profit, less tax, add non-cash items like depreciation or capital allowance, then less changes in working capital and less capital expenditure. This is what we did there. As I keep telling you, we are just refreshing your mind in here. Okay, so nobody is giving you 1 year, but we are refreshing your mind because we know it is very, very important thing in the P4 exams. So how will I calculate my free cash flow? To calculate the free cash flow, I need my operating profit. How do I get the operating profit? I know operating profit. Operating profit is going to be sales, and the sales figure given to me is 525. Let me change the size of the pen. Is 525, and then my cost of sale is 315, and then my distribution cost is 36. I'm representing capital allowance as depreciation. The capital allowance is giving us 46.6, and this will give me my operating profit. What will be the operating profit? Okay, 525 minus 315 minus 36 minus 46.6, that is giving 127.4. I will say less tax. The tax rate given in the question is 30%. So that times 0.3 is giving 38.22 minus, and I have to add my non-cash items, which in this case is the capital allowance. Is the capital allowance of the 46.6. You are calculating net cash flows. Remember, free cash flows are the same as the net cash flows. So somebody could have done tax and tax savings on capital allowance, and then it will bring you to the same net cash flow. When I do this, I ask, is there changes in working capital? Question said no. Is there any fixed capital I need? If you come to the question here, it said non-current asset purchase. This is what we need, 72. Take that 72. That is what is called the capital expenditure, and that is 72.00. The changes in working capital, they said, is not happening, so this one should give me my free cash flow. So 127.4 minus 38.22 plus 46.6 minus 72, and that is 63.78. When I get this 63.78, I need the present value. This is happening in year 0. So I ask, are you growing? They gave me inflation of 3%. So what will be the PV year 1 to infinity? I have the free cash flow now, 1 plus the growth rate divided by the WACC, minus the growth rate multiplied by discount factor of the base year. Because this cash flow is year 0, this is 1, so I don't have to bother myself with it. So the cash flow is 63.78 into bracket 1 point the inflation rate divided by the WACC, which they said is 13.3% minus 0.03 times 1. And what will be the PV? So 63.78 multiplied by 1.03 divided by 1.33 minus 0.03, and that is given 637.8. 637.8. So if it is 637, 1 minute. Okay, fine, 637.8. If it is 637.8, this will be my cash flows, PV of it, and that is the corporate value. If you look at your note, we change it from the nominal to real. It doesn't matter. If you remember what we did there, I don't normally want to change it from nominal to real and keep the cash flow constant. It's waste of time for me because I know the growth formula. If it is growing, this is what I will need. If I don't want to grow it, then I will keep it at FCs like that, and I will divide by what? The WACC, but the WACC should be real. Why will I have to change, go to the Fisher equation to come and do that, while this formula can give me the same thing? That will be just too long for me. Okay, so that is the argument in here. Getting the corporate value, I have to less what? The debt value. And what will be the debt value? If I take the debt value, it gives me the equity value. We've seen all these. Question is telling me straightforward that the market value of the debt is 130, of which its book value is 21. So don't forget to divide by 100. So this one will be 130 multiplied by 21 divided by 100. So 1.3 times 21 is simply 27.3. And when I take it from 637.8, and it's giving me 610.5, and that is the figure. Okay, we all know that one, so we do not have to waste time on this again. Okay, so this is the discounted cash flow method. Once again, I will remind you, don't concentrate on this here, because we have simplified it here for you just to refresh your mind. Getting the time, go to chapter number 2. That is where we did the free cash flows properly. Okay, so now let's go to price earnings ratio. According to the price earnings ratio method, according to the PE ratio method, calculating market price is very straightforward. According to PE ratio is market price divided by earnings per share, or market value divided by your earnings. Okay, divided by your earnings. So giving me a PE ratio, giving me earnings per share, or giving me PE ratio, giving me earnings, I should be able to calculate market value or market price. So my market price should be equal to the earnings per share multiplied by a PE ratio. If the company is an unlisted company, you have to borrow the PE ratio from a similar company. There's this argument, when you pick the PE ratio, you would have to make adjustment to reflect risk and expectation in earnings. P4 is not expecting you to do that adjustment. So when you pick the PE ratio, just multiply by the earnings per share. What earnings per share? Normally, you would have to use the current earnings per share. So far as P4 questions are concerned, you are picking the PE ratio and you are multiplied by the earnings per share of the last balance sheet date. Okay, but if you go to your note, we were just bringing your mind on something. So the analysis that we are doing here is just to broaden your understanding. If you go to the exam room, you are picking a PE ratio and you are multiplied by the last earnings per share. So let's take this example to illustrate. Flycatcher Limited wishes to make a takeover bid for the shares of an unlisted company, Mayfly Limited. The earnings of Mayfly Limited over the past 5 years have been as follows. 2002 up till 2006. The average PE ratio of listed companies in the industry in which Mayfly Limited operate is 10. Listed companies which are similar in many respects to Mayfly Limited. Bumblebee PLC, which has a PE ratio of 15, but it's a company with very good growth prospect. Wasp PLC, which has a poor profit records for several years and has a PE ratio of 7. What will be a suitable range? Here we were just bringing your mind. If I have to use the PE ratio, I need a PE ratio multiplied by earnings. What earnings? Is it the average earnings here? Is it the last earnings? Is it average? If it is average, from what to when? We're just doing analysis. But as I told you, if you go to the exam room, pick the last earnings. Examiner don't even give you any of these. He just gives you the last one. And which PE ratio should I use? Should I use the industry average or should I use similar companies? Ideally, you have to use the industry average, which is more representative. Okay, so if you look at what we did here, we were just making analysis like earnings. How should we think of using? Like PE ratio, how should we think of using? We said average from average for the last 5 years and then last 4 years. We're just doing analysis. Don't concentrate on this too much. You need the PE ratio and the earnings of the last year. That is what will be given anyway. When we came to the PE ratio, which one should we use? Is it the similar company? Is it the industry average? Whichever. So we try to do something in here. But all what I want you to remember is go to the room, pick a given PE ratio, and then pick the earnings per share of the last period, and then you will use it to calculate it. So we try to do this to calculate that. All what you need is you need a PE ratio and you need earnings. That is basically the PE ratio. This is F9 staff. This is F9 staff. Okay, net asset basis. Nobody even bother with the net asset basis in here, even though it is still in the syllabus, so we have to mention it. And according to the asset basis, the value of the company share is the total asset minus total liabilities, and the liability should include what? Preference shares. So it's total asset minus total liabilities. If the balance sheet should balance total asset minus total liability, which is equal to share value, is the same as your ordinary share capital plus your reserves, which is equal to the equity capital. So instead of me doing total asset minus total liability, I can pick the ordinary shares capital and I will add the reserves to it. It should give me the same answer. The only problem here is that where there is goodwill, it's going to create confusion. Goodwill, some school of thought is saying that goodwill should be an identifiable asset, so we have to include it as part of the asset. Another school of thought is saying goodwill, even though you claim to be an identifiable asset, there are so many subjectivities in relation to the determination of the fair values of the asset in calculating the goodwill, so ignore it. So my argument here is if you go to the solutions, especially the old syllables, P4, you don't see asset base, it hasn't appeared. In the old syllables, in the old questions, because at that time, valuation wasn't in F9. When they move valuation also to F9, asset basis and all that went there. So they don't emphasize on them. What they emphasize is what you didn't see much on F9, which is the free cash flow. Okay? So goodwill, when you are solving those questions, you see the same question. One solution from a textbook is including the goodwill. That same question, another solution from another textbook is ignoring it. All of them are right because they are making different assumptions. So when you go to the room, it's your choice. Pick any one of them. Okay, let's take this question to illustrate. Fixed asset, land and buildings, plant and machinery, motor vehicles, goodwill, stock, debtors, short-term investment. Okay, capital and reserve, ordinary shares, 4.9 preference shares, 12% debentures, deferred taxation. Given a balance sheet, what is the value of an ordinary share using the net asset basis? I need total asset minus what? Total liabilities. This is the total asset of 440, and my liability should include preference shares. I've got non-current liability of 70 plus current liability of what? 100. This is giving me 170. There's preference shares of 50. So total liabilities is 220. 440 minus 220 is my total asset minus total liability, which is the share value of what? 220 minus minus the 440 minus the 220 will bring me to 220. Why will I use this long approach? Because we said share value is also the same as ordinary share capital plus reserves. When I sum up these two, do I get a 220? So asset basis, if you understand what you're doing, you can just look at the question, put your hand on your back, and you will get it. It's just ordinary share capital plus reserves. So I will get a 220. In case you want to exclude goodwill, then you have to take the 20,000 goodwill figure off. And when I take the 20, it will bring me to what? 200. And as I told you, it's just two schools of thought in there, so watch out. So here what they did is, we went through the long approach anyway, but they decided to take off what? The effect of goodwill. They decided to take off the effect of goodwill. So that is basically the case. Nobody bother with asset basis. Dividend yield basis, another one. Who cares? This is still primary school F9 staff. Okay, according to the dividend yield is calculated as dividend per share divided by market price. So my market price should be equal to dividend per share divided by dividend yield. It's just a change of subject. Okay, simple. So now let's go to our note. We take this one to illustrate quickly. Okay, Taylor Limited, which has on issue 500,000 ordinary shares of 25p each, intends to pay a constant dividend of 360 net for the foreseeable future. Listed companies within the same industry sector as Taylor Limited currently provide a gross dividend yield of 5% per annum. The current rate of tax credit on gross dividend is 10%. That is 1/9 of the net dividend. Estimate a current share price for Taylor Limited. Okay, estimate the current share price for Taylor Limited. What would we do? I need my market price using the dividend yield. So this is what I'm looking for. That market price should be dividend per share divided by dividend yield. In other words, the market value will be equal to your total dividend divided by dividend yield. Question told me dividend they are paying is 360,000. I will divide by dividend yield. But watch out for something. Before two things can be compared, they would have to be of the same base. Yes, dividend net means they have deducted the tax effect, because dividend normally there's withholding tax of 10%. Okay, so they've taken 10% off the gross in order to give you what? The 360. So that is what I was about to say. Before two things can be compared, they would have to be of the same base. The dividend given to you is after the 10% tax, withholding tax. That is giving you the net. And they're telling you that the dividend yield you are going to give provided a gross dividend yield of 5%. I can't divide the 360 by the 5% because the 5% is what? Gross, and the dividend is net. I have to either do all of them gross or I have to do all of them net. Okay, I have to do all of them gross or I have to do all of them net. Okay, so if I've put 360 net here, then my dividend yield should also be net. And there is tax of 10%, so I will have 90% of the 5% will give me 4.5%. So this is 0.4045, and what will be the market price? So 360,000 divided by 0.045 is giving me 8 million, and that 8 million is my market value. Question wanted market price, and market price should be equal to the 8 million divided by number of shares. What is the number of shares? What is the number of shares? They said in the question that the number of shares, they were having 500,000 25p. So I need to divide the 500,000 by the 0.25. And that is 1/4. So that will give me 2 million. And that 2 million, if I divide this by 2 million, it will give me a market price of 4. Okay, you see me pushing you here a bit because these are primary school things. These are primary school things. Now, let's move on straight to valuation of debt. Let's move on to valuation of debt. Okay, let's move on to valuation of debt. When we did cost of capital, we said traded debt could be either irredeemable or redeemable. Okay, and we said the cost of a traded irredeemable debt, cost of the debt is interest into bracket 1 minus t divided by P0 multiplied by 100, and the P0 is the market price. So now giving me the cost of debt, giving me this, will I be able to get a P0? But the same argument goes. You have to compare like against like. If I want P0, if I say my P0 is equals to the interest 1 minus t divided by KD, it means this KD is net, because here I'm doing net interest. Okay, so you have to compare like against like. So if the KD given to me is gross, I would have to leave out the tax there, so that I would do gross against gross. Okay, but I would have to say normally the cost of debt will be calculated based on gross. Okay, so let's take this example. Current PLC has on issue 7% irredeemable loan stock. The gross return required by investors is 5% per annum. The corporate tax rate is 30%. Establish the current market value for this stock. What will be the market value? We all said interest is a percentage based on nominal value. If the nominal value of a traded debt is not given to you, you assume it to be equals to what? 100. So if interest rate is 7%, 7% of 100 should give me the 7. And I divide by the cost of the debt. Question told me the cost of the debt is gross. So if it is gross, I don't have to what? Net the interest, so that I'll keep everything gross. Okay, what will be the point of you going to do the 7, 1 minus t, and then the 5, 2, you come and do 1 minus t, they will cancel out, leave them out. Okay, that is why value of the debt, we are going to calculate it normally on the basis of what? The gross. What will be the value of the redeemable loan stock? The value of anything is the present value of the future what? Cash flows. Being it irredeemable, it is going to infinity, because we are not what? Paying back. And the present value of a constant interest up to infinity is a perpetuity. And the present value of a constant perpetuity, we said, is that cash flow divided by cost of capital. That's why we got a formula like that. So when it is redeemable, because it will be paid up to a particular point, then there's the need for us to find the present value up to that particular point. So the value of a redeemable debt is going to be the present value of the future cash flows. What will be the future cash flows? The interest you are expected to get over the period, and the redemption value at the end of the period, and the redemption value at the end of the period. And then you will discount using what? The cost of the debt. And the cost of a redeemable debt is the internal rate of return we calculated last week. And we also said that internal rate of return is the yield to maturity, redemption yield, return to maturity, whatever terminology the examiner will use. So let's take this Betty example to illustrate. Betty PLC has issued 1 million of 6% redeemable bonds. Interest payment will be made at the end of March, June, September, and December of each year until redemption occurs on 30th June 2010 at 120%. Bondholders require a gross redemption yield of 1% per quarter. Calculate the current market value of these bonds at 1st January 2007. Okay, now be with me. We said it's the present value of the future cash flows. If it's the present value of the future cash flows, when are we going to get the cash flows? Cash flows here are interest and redemption value. Interest is 6% per annum, but questions say we have to pay them in 4 times so far as March, June, September, and December is concerned. And the debt will be paid off at 120, 30th June. Now is 1st of what? January 2007. So how many quarters am I supposed to pay? Okay, now be with me. If you go to your lecture note and you pick the present value table, when you go to the present value table, you see the, normally we say years, and you see the percentages in here. It's not years, it is N. It's a period. We used to say, oh, years, years, years. It is not years, it's period. The period could be days, It could be years, it could be month, it could be quarterly, it could be half yearly. What is the determining factor? Is the discount factor you're going to use. That discount factor you are going to use, is it per annum? If it is per annum, then your period is years. If it is per quarter, then your period is quarter. So that is what we are using this one to illustrate. It's not only applicable when you are doing redeemable debt. It applies everywhere you are doing present value analysis. If I give you a discount factor which is per month, it means I'm telling you your period is per month. Okay, so here they said 1% per quarter. So we are referring our period to be quarters. How many quarters will I pay interest? Because interest is going to be constant, I have got what? An annuity. Okay, I have got an annuity. So this is what I'll do. I'll do my period in terms of quarters. And how many quarters? Question is telling me I have to pay, now is 1st of what? January. Okay, now is 1st of January 2007. The debt will be redeemed 30th of June 2010. So how many quarters are from 1st of January 07 to 30th June 2010? Whole 2007, 4. Whole 2008, 4, which is 8. Whole 2009, 4, which is 12. And 2010, I will have March and June, making 14. So I have 14 quarters. So within quarter 1 and quarter 14, I would have to get interest. And then at the end of quarter 14, I have to get the redemption value. What will be the interest? Interest is 6% of 100 nominal. Remember, that is 6, but that is for the whole year. So for each quarter, which we have 4 quarters in there, I'm going to get 1.5. So I will say 1.5. And the redemption value at the end of the 14 quarter is 120. I will do cash flows. What discount factor? They said is 1%. I go to my annuity table. I need 1%, 14. We would have said 1%, 14 years, but this time it's not year, it's quarter. So you pick 1%, 14. And if you go to the 1%, 14, you're going to get 13. Annuity, which is 13.00. 1% present value is going to be 0.870. And what will be the PV? So 1.5 times 13. 1.5 times 13 is 19.5, and 120 times 0.87 is 104.4. When you sum them up, plus 19.5 is given 123.9. This is the fastest way you would have to do it. If you look at what we did in the note, we went through long because they wanted the price. So what we did, we used the totals, which is going to be too much. Okay, so that is that. The same thing is what you would have to think of when you are calculating the value of convertible debt. When we did the cost of debt, we said, is it going to be converted or is it going to be redeemed? Because I want to make time for the most important thing so far as the P4 questions are concerned. Okay, so if you go here and it's convertible, when you get here, it is either conversion value, as we know, or redemption value. Test the two. The one which is the highest is the one you would have to put in there. Okay, to be honest, I haven't yet seen preference shares and valuation, which is very basic. It's a formula thing that you can follow. The reason why I wanted to do the value of the debt is because I've told you, when they give you the corporate value, you have to knock off the value of the debt in order to get the value of equity. So when I find the present value of the future cash flows or free cash flows using the WACC, it has given me the corporate value. To get the equity value, I have to knock off the value of debt. If the examiner hasn't given me the value of debt, but the examiner has put this information in the question, I have to use it to value the debt. When I get the market value of debt, I knock it off the value of corporate value in order to come and get what? The value of equity. Okay, look at how we've done all these in different areas. That is the reason why you have to be practicing questions, because when they bring them together, how you do that interrelationship has always been the problem in P4. If they tell you, oh, this is what you have to do, this is what you have to do, you know that you've learned all of them, you know all of them. But when they put all of them in one question, if you haven't got the framework of doing them, you don't know what you have to be doing. That's why I try to bring you to that particular framework. Okay, now let's go to something which is more important to me. Okay, let's go to something which is very important to me, which you need me to explain. Okay, your syllabus want you to do 3 acquisitions. Your syllabus want you to do 3 types of acquisition. All of them, we know them already because we've done cost of capital. The problem is the WACC. If you remember, we all said the corporate value, now be with me, the corporate value is the PV of the free cash flows at the WACC. What WACC? We all said WACC should reflect business and then financial risk. WACC is a problem. So if you have to understand it, life is going to be very comfortable for you. If WACC is a problem, no, this is the tuition phase. Tuition phase, we're not going to do a past question here. It's the revision phase that we will bring those past questions to do that. And what is in your notes? Some of the questions are past questions. So the tuition phase, we're just solving the questions in the lecture note. Okay, yes, solving questions in the lecture note. Revision, I'll bring questions that you will bring all these things together. Brilliant. Okay, so my corporate value is the present value of the future free cash flows using the WACC. And my WACC should reflect the business and financial risk. And we all concluded that when business risk or financial risk or both are changing, then the WACC should also change. Okay, so how we would discount these free cash flow using the WACC will depend on whether our business and financial risk is going to stay the same or not. If the business and financial risk will stay the same, we all said our current WACC is appropriate. Therefore, we can use our current WACC to discount the free cash flows. What if business risk and financial risk will change? If they will change, our current WACC will not be appropriate to do this. So when we were doing the free cash flows in chapter 2, we didn't say anything about the WACC because at that point we haven't taught you the WACC. So bring them together. So when we go to our lecture note, we're going to see acquisition type 1. And acquisition type 1 is telling you that if A is going to buy B, the acquisition of B, bringing A and B together to form a new company called AB, the business risk and the financial risk is not going to change. So if the business risk and financial risk is not going to change, our current WACC is appropriate to discount the free cash flows. So this is what we've been doing. Okay, so WACC is an issue. To be honest, WACC is an issue. So the moment your business risk and your financial risk is not changing, my current WACC is appropriate. So if the examiner wants me to do the equity value or calculate the corporate value, and they have given me the free cash flows, and the question giving me indication that the two companies are in the same industry, upon acquisition, debt equity proportion is not going to change. It means business risk won't change, financial risk wouldn't change. What WACC will I need? I will need my current WACC. I go and calculate my current WACC. I discount, I move on with it. Full stop. Okay, so this is the normal one that we have done so far, which is not an issue. Okay, now acquisition type 2. Acquisition type 2. Acquisition type 2 is a situation where, as a result of buying the other company, your business risk will stay the same and your financial risk will change. Okay, so when we say acquisition type 2, your business risk is going to stay the same, but your financial risk is going to change. How should we evaluate this acquisition? If you remember APV, we said APV is divide and conquer, is separate between business and financial risk. So if my business risk is staying the same and my financial risk is going to change, then it justifies that I should separate the cash flows into operations and I have to separate into financing. And the evaluation method that's separate between operating cash flows and financing cash flows is what is called APV. And we've done APV already. Okay, so all these, we know them already. So when the acquisition is acquisition type 2, where we are buying the other company in the same industry, but our debt equity proportion is going to change as a result of the acquisition, then we have to evaluate the acquisition on the basis of APV. To calculate APV, we need the base case MPV, and we have to do the finance effect. And we said the base case MPV, if you remember, is equals to your net cash flows discounted using cost of equity and geared. Okay, and when I finish, I have to sort the finance effect out. And the finance effect will be my tax savings on interest, my subsidies, and my issue costs. Anyone which is not there, I don't force myself to do it. So now let's take this simple question or this past question. Even if I say simple, I'm wrong. This past question to illustrate. The directors of Hinka PLC are considering the acquisition of News Corp Limited, an unlisted company. The shareholders of News Corp Limited are willing to sell the business on 1st January 2009 for $500 million. From the perspective of the directors of Hinka PLC, the projections of the performance of News Corp Limited are as follows. Current projections during planning horizon. So these are your current figures. Earnings before interest and tax, depreciation and amortization. Earnings before interest and tax. Interest charges, profit before tax. The assumed rate of corporation tax is 5% per annum. The terminal value of the investment is treated as a constant perpetuity equal to the free cash flows for the year 2014. If subsidy or issue costs are not given, should we still use APV? Yes. If subsidy and issue costs are not given, you still have to use APV because the acquisition will result into change in financial risk, and as such, we would have to separate them. So even if you don't see subsidy and issue costs, you still have to use APV as long as it's a measures and acquisition type 2. Okay, the assumed rate of corporation tax is 35% per annum. The terminal value of the investment is treated as a constant perpetuity equal to the free cash flows for the year 2014. The risk-free rate of interest is assumed to be 6% per annum. The return on the market portfolio is taken to be 13.5%. Whilst an asset beta of 1.1 is used for the purposes of the appraisal. Annual capital expenditure from 2008 onwards is estimated at $20 million each year indefinitely. News Corp Limited currently has on issue $400 million of 8% debt, and it is intended that all available cash flow should be applied to repaying this debt at the earliest opportunity. Advise the directors of Hinka PLC whether to proceed with the acquisition. Okay, the original question, they gave you the indication that this one is an acquisition type 2. So if it's acquisition type 2, you would have to value it on the basis of what? APV. To get the value based on APV, what do I need? I need relevant cash flows. How will I get relevant cash flows? The future. They haven't given me sales variable costs and all that, but they have given me accounting information. giving me accounting information. How will I be able to get net cash flows? Net cash flow is the same as free cash flows. Do we know how to calculate free cash flow? Free cash flow says your operating profit less tax on the operating profit, add back non-cash items, less working capital if any, and less capital expenditure if any, and I will come and get my free cash flows. So they've given me my profit before interest and tax. This is my profit before interest and tax. I am not interested in the current figures. I'm interested in the future. So if I'm sitting down there, I will pick these ones. Okay, then when I get the profit before interest and tax, I will apply the tax on it. Okay, so if you are going to flow here with me, okay, don't bother yourself with the 2008. You see that subsequent, they didn't bother. So when you are sitting down there, you haven't got time to do that, because 2008 is now. We want the present value of the future free cash flows. So you have to pick your profit before interest and tax. You less your tax. When you less your tax, you have to add back your non-cash items, which was the depreciation and amortization. And when you add back your depreciation and amortization, you would have to think of, is there any working capital? Question didn't say anything about working capital. Is there a fixed capital to be paid? Question said, yes, we have to purchase non-current asset. He said, annual expenditure. Annual capital expenditure from 2008 onwards is estimated to be 20 million each year indefinitely. And that is your capital expenditure. You are calculating free cash flows. And you have to picture operating profit, tax, add non-cash items, less increase in working capital, less capital expenditure. Anyone which is not there, you skip to the next one. Here they didn't give us working capital, I skip. So I got my profit before interest and tax. I apply the tax on that. Remember, we said because it's free cash flow, we don't have to bring interest. And then we apply the tax. We got the tax. Okay, we add back the non-cash items, which is depreciation and amortization. We deducted what the capital expenditure, and this will give us the free cash flow. When I get this free cash flow, because I am calculating APV, this free cash flow is the same as the net cash flow. If I've got a net cash flow, APV will tell me my base case MPV should be calculated as those cash flows discounted using cost of equity and geared. And if you remember, we separated them into two. Cost of equity and geared, is it preposition way or is it geared and ungeared beaters? Remember, is it geared and ungeared beaters? The one I would have to use depends on the question in front of me. Was I given beta or was I given cost of equity or WACC? If they've given me cost of equity, I go to preposition 2. If they've given me WACC, I go to preposition 3. If they've given me beta, I have to go to the geared beta approach. And I said, if they have given me beta here, then I need to go to the beta level. I have to pick this proxy beta. When I pick that proxy beta, I need to ask, are you geared or ungeared? This question told me asset beta, and asset beta are ungeared beta, measuring only business risk. So when the proxy beta picked is ungeared and is measuring business risk, you don't ungear again. If you remember the stages, proxy, if it is geared, ungear it and then put it in the capping to get the cost of equity ungeared. Beta given to me is already ungeared, straightforward. I have to put it in the capping to get the cost of equity ungeared. That is the reason why they did this one straightforward for you. And they got a 14.25%. Get the present value of the 14.25%. Okay, so they discounted it at 14.25% up to year that, because the question also told you your perpetuity is the constant figure from the 14. So they did from 2009 up to 2013. They discounted that up to 2013, and they got this net PV of that. And they are projecting from 2014 up to what? Infinity. And it's a constant cash flow. So this infinity or perpetuity It's a constant cash flow. Here, we need the free cash flows, not the free cash flows to equity. We need the free cash flows, not the free cash flows to equity. We are calculating APV. It's the same principle. We are calculating APV, so you need the net cash flows. We are just separating financing from operations. Okay? So when you get the perpetuity, that perpetuity is a constant perpetuity. And we all know constant perpetuity is that constant cash flow divided by the cost of capital multiplied by the discount factor of the previous year or the base year. Because it's 2014 to infinity, we have to pick the discount factor of 2013, which is 0.514, and that is that. And when you sum up these two, it gives you the PV from year 1 up toward infinity. This is the place I'm going to deviate slightly, because I don't want you to deviate from your normal APV, because we all said your base case NPV, is the PV, okay, is the PV of the cash flows using cost of equity and geared. Okay, so when I find the PV or minus the initial investment, the PV of the cash flow at the cost of equity and geared is what we have got as the 977.78. So 977.78. I will less the initial investment. What is the initial investment? If you go to the question is telling you the other company want to sell to us for 500,000. So if they want to sell to us for 500,000, you are buying it at 500,000. That is like your initial investment. Measures and acquisition is an investment appraisal. So 500,000 becomes the initial investment. Take it out of it and you will get your base case NPV, which is going to be, is it 477.78. This is my base case NPV. When you get your base case NPV, then I will need PV of my finance effect cash flows, my finance effect cash flows. And the finance effect cash flows, what will be the finance effect in the question? There is no issue cost, there is no word subsidy, but the question gave us interest. Look at interest charges. These are the interest. And we need the present value of the tax savings on the interest. So any of the interest you are picking, you need to multiply by the tax rate to get the tax savings, and you have to discount it to get the present value, just as we did with the APV. Okay, now how am I going to discount it? APV couldn't tell us the discount factor you have to use to discount the cash flows associated with the finance effect. So APV assumes either you use the risk-free rate or you use the cost of debt. So look at what we did here. We picked each of them. Okay, this is the interest. We multiply by the tax rate to get the tax savings on the interest, and we discounted it at the cost of debt, which is 8%. 8% year 1. Year 2, we pick the interest, apply the tax on it to get the tax savings, discount it at 8% year 2. Year 3, this is the interest, apply the tax rate to get the tax savings, multiply by discount factor, year 3. Year 4, pick the interest, tax rate, discount factor. Year 5, the same thing. And when you sum up all of that, it gives you the present value of the tax savings on interest, which is 27.37. So we will say 27.37, and this should have given me the APV overall. Okay, so 477.78 plus 27.37, and that will give me 505.1. This is the value overall, which is the same as the corporate value. But we said the corporate value is value of equity and value of debt. So when we have debt, according to the question, we have debt of 400 immediately. Now we have debt of 400. If we have debt of 400, what will be the value? So debt value will be the 400. What will be the value attributable to equity holders? 105.15. And as such, we will be able to increase our shareholders' wealth by 105.15. Why shouldn't we go and acquire the other company? So what will I tell you here? I don't tell students, sit down here and look at it critically. If you'll be able to value acquisition type 2, it means you know APV. So if you do your APV, master it, you come here, you roll it over. Okay, acquisition type 3, we're going to see next week. I am going to roll you over again. We are going to look at the principle of WACC of combined activity, because we are going to bring two companies together. As a result of the acquisition, if our business risk and our financial risk will change, because now we are A and B together, we have combined business. How would we calculate the WACC of combined business? It's the same as WACC of what? Combined activities. The same principle. So have a revise through that, so that when I see you next week and I pick the WACC of the combined business, you will see that same principle that we're going to use. Our time is up, so I'll keep you, I'll just keep on revising, and any questions that you have, you can send them to me. Okay, so whatever we've done today, more or less, is a repetition of whatever we've done in the past. So consolidate those ones. When you come here, you just roll them over. So thank you very much for your time, and I'll see you next week.